Hi there, it's John Thompson with the TG Loans mortgage team. Today we're going to be doing our Borrow Smart, Repay Smart video lesson. And today we're talking about, let me get this over here. We're going to be talking about some of the reverse mortgage myths, actually just one specifically. And it's one we hear quite often, that reverse mortgages are expensive. And so there obviously are costs involved about this. And I find this kind of a curious thing when people call financial products expensive. I don't really know where it came from, but it seems like most people have this built-in belief or myth that reverse mortgages are expensive. So in reality, every mortgage, every real estate transaction has expenses related to it. And oftentimes what I find is that people don't already understand the correlation between the value of something that's being done and the price that it takes to get that done. And of course, are people making a full analysis? Are they exploring all their options? And are there options that are less expensive or maybe have no costs? And then, of course, how do you put a value on the financial impact of any product, right? And so, what's the long-term impact of that, and how does it really help, life or sustainability and what are it? So let's kind of compare some of the expenses in a reverse mortgage. This is not meant to be comprehensive. It's sort of just an overview of a way you might approach this thinking. Every situation is unique and specific, and so there's not a one-size-fits-all in this conversation. It just sort of compares a couple of different things. So we're going to compare a $750,000 home, a $250,000 traditional reverse mortgage, and let's just assume that the homeowner is 68 years old. And so they have a $750,000 home. They'd like to age in place. They need $250,000 in order to have a sustainable plan for the next 20 years. And then we're going to compare basically a $250,000 traditional mortgage, a HECM reverse mortgage, and then maybe selling and trading down. Maybe that's an option as well, which is always an option, right? So on a $250,000, the mortgage amount of refinance costs around $4,000. It's going to give them a payment of about $1,200. Maybe the rate of interest is 4%. The interest costs over 20 years are about $120,000. And they're going to put out $288,000 in payments of this payment over that 20-year period. There's a balance of $118,000 left. That's to qualify for the mortgage. So in order to get that mortgage, a 250 mortgage, you have to have the income to qualify and the assets and the credit to qualify for that mortgage. A $250,000 HECM, the costs going to run about the same on the low side and maybe up to about $9,500 on the high side. There's HUD mortgage insurance, which provides protection. And I think this is where this idea comes from, that a HECM is expensive because this insurance is built into it. But the insurance delivers some really great benefits that maybe people don't completely understand. The interest rates are going to be very similar to a forward mortgage. There's no payments ever required, but you can make payments. You are going to obviously have higher interest costs because you're not making a payment. So the interest costs over 20 years about $350,000. But in exchange for that, they also get $288,000 of cash flow because they didn't have this payment over here. So now you start to think about, so wait a minute. So I didn't put out $288. What's the cost and what's the value of that? The balance, of course, is much higher because you deferred all interest over time. Now, what about selling and trading down? Well, the real estate commissions and cost of selling, $52,000. The cost of moving or relocating. They've got $250,000 left over to purchase a new home because, of course, they got to set aside $250,000 for their plan. And then the question becomes, is that actually better than aging in place? Or is it even possible? I mean, is it physically possible for them to move? And is there a place they can go where there's support and resources they can get to for that time? And if they put that $250,000 someplace, what are the expenses to manage that money? Are they going to buy an annuity? Is there some sort of financial management involved in that same situation? Those are all expenses to kind of consider. One more quick example. So this is a $1.5 million home. They want to age in place. They need $500,000. So kind of the same picture, just maybe twice as big. So a $500,000 mortgage over here, you'll see the expenses, $4,500 for refinancing costs. They got a payment of $2,400. Similar interest cost, $240,000 in interest expense over 20 years. But payments of $576,000. So you've got quite a bit of cash flow going out, a balance of $235,000. And of course, they got to qualify for that $500,000 mortgage, which is not the easiest thing to do in the world. We compare it to a $500,000 jumbo reversed. There are programs now that have no costs at all on the jumbo reverse, up to maybe $4,500. So very similar costs. In fact, maybe less costs. There's no mortgage insurance at all. The interest rates are higher. And then you have no payments, of course, required. So the deferred interest over time is pretty significant at the end of the day. But you had also a cash flow of $576,000. So there's a significant difference between those two different things, and it balances up to $1.6 million. Of course, the home value is much higher now. The home value is probably up into the $2.5 million range. Okay, or they could sell and trade down. $105,000 commissions to sell the home, moving, relocating expenses. They got $900,000 to purchase a new home, $500,000 set aside for their plan. And is that better than aging in place? Could very well be. And then, of course, the expenses to manage that money over time. So are reverse mortgages expensive? I think it really just depends on what the situation and so forth. In some cases, the expense to get a reverse mortgage is actually less than a conventional mortgage and much less than selling a home. And obviously, it's a personal choice about how to use an asset most effectively for income planning. There are costs for any kind of equity extraction product, whether it's a mortgage, reverse mortgage, line of credit, or some of the other newer products that are coming to market to extract equity out of the home. All of them have costs. At the end of the day, cash flow is the most critical component of this in retirement. And cash flow can only come from a couple of places: Social Security, pensions, investments, family or home equity, right? So maybe people are going to help you out paying money, but maybe you could consider using, the home equity. The really smart question is really, what's the cost of either not doing anything and what are my alternatives? In other words, if you do nothing, what's the cost and expense to you and your family if you don't do anything? And of course, explore all the alternatives is the best way to approach this. Okay, so that's it. Thanks very much for taking the time to listen in, and we'll talk to you soon.